So once you've done all that, apart from the sale, which I'm going to ignore because that's a pretty easy thing to do, you've dealt with all the entries required for a fairly straightforward joint venture scenario. So let's just map out what's happened in this particular case. So A has put in $400,000, and I'm just going to do it in thousands. B has put in $600,000. At the end of the year, the joint venture is worth $650,000. So that is the net assets in the joint venture. The joint venture has also distributed, or, well, I say or, just any sort of product, we don't know what it was, has distributed product, and in this case it was 210, and in this case it was 140. It is also picked up, A has picked up the 40% of the net assets of the joint venture, 260, and B has picked up 60% of those net assets, which is 390. And what we can see here is the 140 plus the 260 gives you the 400. 390 coming back and the 210 going back gives you the 600. So when we look at the blue items, though the amounts that are coming back onto the books in A and B, we have the full 1,000 across the two of them going back onto the books, which weighs up with 1,000 going out as the interest in the joint venture. So everything's quite nicely matched up there. There's one adjustment that we need to make on top of this, which is, and let's just look at A. There has been a transfer between the assets of the joint venture, which the percentage share of the assets of the joint venture in A's books, into the inventory, and that is picking up the depreciation amount. So what we actually end up with is inventory with 164 and assets at 236, but importantly it all still adds up to 400, and that's the value of what was put into the venture by A in the first instance. Hopefully that helps somewhat. Any comments or feedback, I'd love to hear them. Thanks. Bye.